No, you're all exemplary speakers. I have to say, I'm absolutely amazed. It's the first time I see that all introductory expositions are extremely concise and full, of course, of messages. So thank you very, very much. I am very impressed by the number of issues that have been mentioned, of course. I did not mention myself what I put in my own paper, and I tried to be comprehensive. We had Daniel giving us so many dimensions. So I think that we will have a very, very, I would say, stimulating discussion now, according to the rules I have already mentioned. Let me only mention that in what I heard, I see a lot of interest of questions on why is it that the level of investment is so poor since the crisis in many economies, not only in the advanced economy, China being a case in point, but for the reverse, I would say, behavior. I am always struck by the fact that productivity was mentioned by practically all speakers. And I would like personally to ask a question on whether you buy or not the Gordon observation, Professor Gordon observation, that we had a high level of total factor productivity increases from 45 to 73, first oil shock. Then we had a low level of productivity progress from 74, say, to 95. Then 95 was the end of the solo paradox. We could see an explosion of productivity, and we were back to the level of 1.92% that we had after World War II. And then since 2005, we are back to square one, if I may, namely to the level of total factor productivity that was the case from 73 to 95. They were a very poor one. So the problem is, are we ourselves in the normal situation that proved to be the case during 20 years from 73 to 95, or is it very abnormal that we are at that level, which is the intuition, and we should go back to the level we had from 95 to 2005? But by the way, it was only a 10 years period. So I myself am totally struck by these observations, and I have an enormous difficulty. My intuition is that the disruptive technologies that André was mentioning, the IT, the explosion of startups, all what we see, the artificial intelligence and the rest, will probably trigger an enormous amount of productivity progress and of total factor productivity progress, but we are not yet there, and we are back to this solo observation that we had a lot of investment in computers, but he didn't see the consequence of this investment in terms of productivity progress. So it is maybe something which will be proved in the future or not. I mean, at least I'm struck by the fact that there is no academic consensus on where exactly we stand there. And of course, we had also a large number of other issues mentioned in the real economy. As regards the mention of main issues in the financial sphere, I could note myself, of course, the structural difference between Europe and the US, which is a very, very important point that you made, André. I also see the absolute need to reduce leverage and to be sure that we do not augment the debt outstanding in the private sector as well as in the public sector as a proportion of GDP. And from that standpoint, John, I'm frightened by this motto, spend, 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 and borrow, 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 it is time to borrow, because I heard that before, and it was only paving the way for major difficulties, so we have to be, it seems to me, very prudent and cautious. But of course, the stress on equity, the absolute necessity of equity being a normal way of financing our economies seems to me very, very, very important. So a lot of other things could be mentioned, but what we expect is the contribution of the audience. So I see that you are raising your hand. Please, you have the floor.
I wanted to ask a follow-up question to something that Jean-Claude just said. So if the panelists could do a little bit of a deep dive on the impact of technology on some of the trends that were mentioned here. So I wonder if they could comment on the decoupling of productivity and hourly wages, what's driving that? Do they think that that's behind perhaps the collapse in aggregate demand and ultimately in investment? What do they make of this thesis of secular stagnation that is linked to the impact of technology on the labor market, on the distribution of income, and how that's driving wage stagnation, inequality, and other issues? So it's a very large topic, but I'd love if the panel could comment a little bit on that interaction between tech, income, consumption, investment. Thank you.
Thank you very, very much indeed. We will take a batch of questions, of course. Please, Monsieur Richard.
Yes, thank you. I'd like the panel to elaborate a little bit about regulation. Do we have a trend of over-regulation in the banking and financial sector? I must say, well, personally, I think it's not the case, but I heard many comments on that. And is it, well, of course, if there is over-regulation, it has an impact on the European banking sector, particularly thanks to the explanation you gave us. So I think we should clarify this point first. And I know that Mr. Kyoto-Ido has mentioned that we should move from regulation to dynamic supervision, having in mind that there may be too much regulation. So I think it would be worth spending a few minutes on that. Thank you.
Thank you for your question. Madame.
Merci. I have a question maybe for Mr. Dayanu about the central banks, the fact that we're going to have diverging path in the near future with the Fed raising its interest rates and the others being very accommodative. What could be the impacts, and is there any shortcomings to that? Thank you.
Thank you very much. Please.
Yeah, just like to highlight three points that of, let's say, relative optimism, just to rebalance a little bit the discussion. Number one, demographics have had a very big effect on long-term growth rates in recent years, including in the United States. Sharp deceleration in the labor force. And number two, another factor in the long-term growth rate reduction, which is overlooked in my view, is what I call the end of transition, meaning with the fall of the Berlin Wall, what was it, 25 years ago, we had this huge inclusion of a large number of countries into the world economy. That has largely happened, and the productivity growth from that is waning. So that's a natural development, not one that should lead to pessimism. And the third that is overlooked is, and is remarkable in my view, is the absence, relative absence of large balance of payments crisis in the emerging markets. I know there are some, I'm very aware, but if we remember the experience of the late 1990s, the early 2000s, it is extraordinary that despite all these issues, the emerging markets have by and large remained stable, with some very large shocks in Brazil, Russia, etc. There's very little recourse to balance of payments help from the international organizations. There's some, mainly in the Middle East, but in fact, all the big players are by and large managing on their own.
Thank you very much for your observations, which will certainly call for comments as you are asking. Thank you. It is 1, 2, 3, 4. Maybe we could take a fifth question in this first batch, if there is one. Yes, please.
I just want to raise solo paradox. How do you explain the difference of growth rate between the US and the Europe, if not this technology effect, as clearly explained by authors like Gordon, who showed that the difference of growth is mainly explained by difference in technology and IT incorporation in production. Thank you.
So same question on impact of IT, but on Europe particularly, is it? No, in the advanced economy as a whole, in all economies in the world, I guess. Huh?
It was clearly explained that in the US, this effect exists. The IT produce effect on growth.
Okay, thank you. So it was the fifth question, and we are totally, I would say, flexible. So if you pick up one particular question which seems to you particularly interesting, you respond. I will ask the panelists to be very concise also in their response, but very generously I will give them, I would say, 3 minutes each to comment on the questions we just heard. But if they want to be longer, they can negotiate with me. So, because I accept fully that some questions are really, really very, not only pertinent, but also calling perhaps for some important response. But perhaps we could take the reverse order, and I know that you will have a lot of things to say, and I reserve for you more minutes, Mr. Professor. André.
Thank you. I'll take two questions, if I may. One is on the impact of technology and productivity, and the other one would be on overregulation. Is there overregulation of banks? On the impact of technology, let me take an example. I invest in startups, and there is one I'm interested in which does managing accounts receivables for companies using the cloud, basically, okay? The impact is very simple. There are fewer jobs needed, and there is capital saved. So it's positive. Now, so the question is, what do you do with the people, right? So we do have a major problem in France of education and training. We have a problem with primary education, which is well identified, and we lack probably 10,000 or 20,000 or 30,000 computer specialists, which we have to train. And there are efforts being made in this direction. Now, that doesn't mean that it will solve the problem, but it is clear that there are things to be done very quickly and longer term on the primary education and very quickly on training. And we have cases of schools now who take people with no diploma at all and just test them to see if they are computer friendly and they train them. Okay. Again, not a solution, but it's true that there is a productivity gain there, obviously. On overregulation, I don't believe the word is overregulation. I think it is clear that regulation has been done basically to avoid systemic risk, which is a good motive, and two, to avoid having the taxpayers pay for the failure of a bank, clearly. But it can work as long as somebody, I mean, especially the shareholders or the state, or a combination, has fixed the key problems of banks before. Because otherwise, you get into a vicious circle. Banks have to raise capital. They are not profitable enough to do that. They don't find the capital. And you get in this situation where, again, we have a couple of situations in Europe which clearly cannot be solved just by the market. And we are in that vicious circle. So that's one point. The other point of overregulation is bureaucracy. The one bank I'm involved with as member of the supervisory board, the cost of compliance, the cost of internal audit, the cost of everything which has to be done of regulation has been multiplied by a factor of 5 or 10. Now, again, it doesn't break the bank, but it means that we spend more time on checking forms, while I think the money should be spent basically on improving, which is already good, on the quality of the people who monitor the system. In France, the ACPR, they are good people, but these are the key people. The problem with the 2008 crisis in the US was clearly a problem of regulation, but also a problem of control, I mean, of proper functioning of the authorities which are supposed to do the job. So I think we put too much emphasis on the numbers, too much emphasis on the forms, and we could put more emphasis on the quality of the people on both sides.
Thank you. Thank you very much indeed. Who else? Reverse order, please.
Okay, I pick up just two questions. Number one is the lack of a balance of payment crisis in many emerging economies since the Asian financial crisis. Of course, you are not missing the good balance of payment crisis in emerging economies, but I guess there are a couple of reasons. The lesson of the Asian financial crisis was cast a long shadow. And if you look at the reserve level of many emerging economies, after this crisis, the level of the reserve has increased quite a lot. Of course, China is the major country, but other countries also at the same time. So they are more careful. They are more careful about the current account surplus as well as the accumulating reserves, even though sometimes they are criticized by this so-called savings glut. But from their point of view, it is an insurance at the end of the day. So that's number one. The other thing is that they now know the danger hidden in this short-term bank borrowings. The most capricious element is this short-term borrowing between the banks. That was the major problem. And IMF changed its view in 2012 about capital flow management. And now G20 is talking about so-called capital flow management as part of a macroprudential measures. For example, in Korea's case, we introduced a couple of measures following these macroprudential principles, and that has been very effective in changing the structure of the borrowing. It does not change the total amount of borrowing from abroad, but it switched from short-term borrowing to the long-term borrowing, and I think the international community should look into this more carefully to get the good practice, best practice. And now OECD itself is reviewing its capital code of liberalization. I don't know in which direction it's going to go, but it has to go with this more prudential capital flow management. And another thing I have to mention is that it's not really a balance of payment crisis, but there's a liquidity contagion crisis. And during the 2008 crisis, Korea has almost no exposure to this toxic mortgage debt. Still, we suffered from the credibility crisis, and it takes the Federal Reserve to come up, U.S. Federal Reserve, to come up with the helping hand with the bilateral swaps with the 4 emerging economies. So in other words, a good balance of payment crisis is the one thing we should guard against, because that's something each country should blame itself in the first place. But this liquidity crisis driven by this contagion or sometimes guilty by association, whatever you name it, it is something beyond each country's control. And that's one of the reasons the IMF came up with these new tools. But probably we have to be more aggressive in exploring the options in central bank swap among the most advanced countries in the times of that kind of a crisis. And productivity, I just want to mention that sometimes productivity at the end of the day requires a lot of reform and deregulation against vested interests. And unless you have a good political capital, sometimes it's not easy. In Korea's case, we did not waste a good crisis in the Asian financial crisis. That has helped us quite a lot, but on the other hand, it's already 20 years ago. And even though we do not regret it, we don't have a good crisis since then, and that weakens the political capital. So other than political capital, another thing is basically market pressure. That's again, we need a very active trade sector, as well as another thing I have to mention is this rent seeking by the new type of companies. In other words, there's a concentration of businesses. And when we have seen a case like between Samsung and Apple's intellectual property legal case, then you can see this the traditional protection of intellectual property right, which derived from pharmaceutical industry, may not apply to this new IT industry, and we might come up with a shorter protection. So that this knowledge-based capital that tends to have this accumulative tendency may be shared abroad more broadly so that whatever technological gain we have on the IT sector can be actually translated into productivity gain across the world much more rapidly than current situations. Thank you.
Thank you very much indeed. Listening to what you said on the balance of payment crisis and so forth, and thinking of one of the issues that was mentioned by the last question or the previous next to last, I was struck by the fact that when we had the I would say dramatic Latin America crisis in the 80s, and we have some memory of that, John and others, when we had the crisis of other countries in Africa, in the Middle East, when we had Poland, when we had Egypt, when we had the Asian crisis at the end of the 90s, we had a very, very strong adjustment. We had very, very important measures taken by all those countries, and it is my way to explain why they were not hit at the moment where the crisis hit the advanced economy. I mean, they had done a lot of hard work, which had been recommended by the IMF and the international institutions, were challenged, of course, because it's always very difficult to adjust, but proved extraordinarily effective in preserving the emerging world from this drama which was unfolding in the advanced economy. One of my major fear is that in the case of the crisis of the advanced economy, which by the way was not, apart from a few countries, a crisis of balance of payment or a sovereign risk crisis, but there was a crisis, and the idea that we have to adjust does not really, I mean, I'm speaking of the advanced economy, is not really in the air. The message for the advanced economy is more, you're so important for the entire world that don't adjust too much, please, and be as accommodating as you can. It was not at all what was said to the emerging economies. I'm noting that en passant, but I think there is something there which might be a little bit worrying for the future. Now I have Monsieur Ido, and then Monsieur Sharafeddin, and then I promise you that you'll have a first time at the end, sometime at the end, Professor Dayanu. Please, Mr. Ido.
I'd like to also take the two issues. First one is that the total factor productivity issue. You know, to discuss about that TFP is very difficult, because one thing is that in any way TFP is calculated as a residual of, you know, other, so to say, productivities. And second is that recently in Japan, the calculation of GDP itself is in question. I think it's this issue is all over the world, especially how to calculate the value added in the servicing sector, or that the intellectual property business. In those areas, to calculate the GDP itself is very difficult. So we would be always careful how to calculate or how to evaluate the TFP figure itself. But having said that, maybe the reduction of total factor productivity has several reasons, especially in the case of Japan too. First one is that, just as I said, you know, in these days, the participation of women and the elderly in the labor market has increased. Of course, that the direct impact of those influences is, so to say, reflected in the calculation of labor productivity. But I think indirectly, it has also it has given some impact on the total factor productivity, because you know that now many women have started to join the labor market, and they are not so much skillful in IT technologies or that in the business environment itself. That is one reason. Another, so to say, reason in the case of Japan is that change of working style. You know, under the Abenomics, we are now trying to change the working style itself. Japan had been for many years very notorious, you know, long time working and very hard working. But now we are going to, for example, that when I was in Mr. Finance, when I was young, my overwork hours, monthly overwork more than 300 hours. But nowadays, it has been very drastically reduced to 50 hours or something like that. So in that way, it's also directly related to that, the labor productivity, but also I think that it's also reflected in that the reduction of total factor productivity. So I think the reduction of total factor productivity itself, we should be careful to evaluate such kind of reduction. That's my first comment. And second point is that as regards my comment, from the regulation, static regulation to dynamic supervision. Of course, I think this concept itself has been shared now by not only by my colleagues in Japan, but also in the world. And of course, the banking financial business is a very global business, so we need some global standards with numerical guidelines. But on the other hand, financial business is different country by country and also sector by sector. Therefore, that I think we need at least some numerical standards as regards banks, so to say, the regulation. But on the other hand, we should pay also more attention to that, the more flexible supervision, depending on the economic situation, we should change the style of the supervision, and also that the recent very rigid regulation on banking sector has pushed financial business to shadow banking areas or other, the non-banking financial business in the market. So I think in any way, we should be more flexible as regards the regulation system itself.
Thank you very much indeed, Monsieur Ido. Mr. Governor Sharafeh.
Thank you, Mr. Chairman. There are three questions that can be of interest to me. One is on over-regulation. The second one is on... Is going to say something? Okay. So one is on over-regulation. The second one is on knowledge economy. And the third is on demographics. However, I decided to spend whatever time I have on demographics because the case we have is rather peculiar. Lebanon's population has increased from 4 million to 6 million in the course of 2 years. That's not because we're overproductive. You know why, John? That's because of the Syrian influx, because of Syrian refugees coming into Lebanon. We are active, but we're not that active. We're productive, but not that productive. And this has really, it has raised lots of concerns on so many different fronts. In the context of this forum, I would restrict it to the economic dimension rather than going on to demographics and to security, onto social and humanitarian and other aspects. The cost of the Syrian war has been over $12 billion on Lebanon. And the cost of the refugees themselves, when we're talking about $12 billion, over $12 billion, we're talking about the cost, the reducing Lebanon's GDP, we're talking about by an annual % of 3. We're talking about the cost that is on our infrastructure, the cost in every single thing that you can think of is shared all of a sudden by 50% of the population. And the impact of that on the public finances, the impact on the human and social development, we have more poor people in Lebanon now. We have almost now 1 million people 1 million Lebanese people under the poverty line out of the 4 million, because our Syrian guests are sharing just about everything with us. The job markets definitely is impacted adversely in so many different ways. Health, education, they're all shared. So with same schools, same hospitals, same services that we have, same transportation, same electricity, we don't have enough of anyway, but we're sharing it with yet 50% extra of our guests. water and sanitation, education. We have 170,000 school children in our schools. We don't have 170,000 Lebanese school children. The production rate, the fertility rate is amazing. They're really productive. We don't have it. There are more Syrian births than the Lebanese birth. And the solid waste issue, the electricity issue, the transportation, and you know what? At the same time, the dispersed amounts, we have the international funding, so the international donors, IMF, UNHCR, just everybody is just pitching in. Lots of countries, Arab countries and otherwise. But the thing is, up until 2016, up until this year, there were the promised monies were over $7 billion, and effectively what was dispersed is less than half. So the gap is like $3.6 billion, and this is what's really just to make ends meet in that context, not to refurbish anything, not to really remove the impact of anything, just to keep the same level of services that we have. That is, we're not counting the long-term effect on so many different aspects. We're not counting on the issue whether those Syrian guests of ours will stay or not. So there's so many different aspects. So all of a sudden, when the gentleman asked about demographics, all of a sudden I had a different twitch, because demographics for us talks about totally different thing. So I wanted to take my time talking about this. If there's any more time, I'll talk about two other issues that are of interest to us: overregulation and the issue of fintech or technology economy. Thank you, Mr. Chairman.
Thank you very much indeed, Raed. It was fascinating. I could see somebody raising hands over there constantly, so he should know that if he raised two hands, he has the right to speak for 30 seconds. But we are still, I'm sorry to say that, but we are still in the round of the speakers. You see, that's the reason why I don't give you the floor. You will have it immediately afterwards. You will be the number one. John.
Thank you. And I'll be very briefly, some more time for Danielle. Just a few comments on what's already been commented on. Just a remark on technology, and one that, in line with your introduction, Jean-Claude, that history shows that productivity associated with technological gains tends to move in waves and not in a straight line, which is one of the reasons why my old professor, Paul David, pointed out to Bob Solow that part of Solow's problem was that in his models, productivity is a constant. And he says that actually has nothing to do with how the real world works. And in addition, so it's not so surprising that we've seen what we've seen. Secondly, the argument that technological advance exacerbates income inequality seems to have become accepted, even though I think it's strictly a post hoc ergo propter hoc argument, in the sense that it always struck me that in the long run, technology makes the stupid smart and the weak strong. So it's not obvious to me why it should produce increased inequality, unless you can assert that technology is accessible only to some and not to others. But that's not the history of technological advances. So I'm just cautious on the notion that somehow it's technology that is causing the problem of inequality. And after all, in the US context, the largest increase, if we've become fascinated with the 1% versus the masses, if we look more broadly, the 10% or 20%, in the United States, the sharpest increase in inequality occurred in the 1980s. And it wasn't that it wasn't noticed. And also the biggest trade liberalization, the last big trade liberalization in the US occurred in the 90s. And that's when the US had the largest trade deficit. And yet, we didn't hear such clamoring about the effects on the economy, on jobs and inequality. And I think the reason was because the economy was growing relatively smartly in that time. And I think that's a lesson for now, that if we could increase growth, perhaps some of the perceived problems that don't have such easy, obvious solutions wouldn't seem so pressing. So I'm optimistic on this scale, but then let's translate this into the financial sector. In the U.S., at least, it's clear where there's fundraising occurs more in the securities markets than through conventional banking. If you look, market prices, certainly the equity market, seems to reward companies today for share buybacks and mergers, and relatively punishes those that announce big capital spending programs. So it's worth asking why is that? Is it a reflection of deep uncertainty, perhaps a risk aversion growing out of the crisis? Perhaps it's an effect of population aging and folks less willing, investors less interested in taking risks and more interested in safety of income. But perhaps it's something that we've done to the financial sector and is worth thinking about. We can see well-intentioned and unintended consequences of well-intentioned efforts. For example, to be blunt, you may have noticed that efforts to thwart money laundering and financing of terrorism has resulted in the collapse of correspondent banking relationships internationally, a completely unintended result that officials have been very reluctant to recognize and act upon. But also, I suspect in the regulatory environment, we could go on about it, but I had been hopeful that at least we were in a situation in which the basic regulations seemed stable and the system could continue to accommodate that. And I have to say, as I said in the outset, it now looks like that may not well be the case. In other words, if the U.S. is now going to revise Dodd-Frank, if it's in a meaningful way, then everyone will need to react. Even if we decide that the new changes are positive, they certainly will inject new uncertainty into the markets. Let me just add, this is perhaps a little into the weeds, but in response to what Mr. Hurst said, I do think that one of the systemic issues still outstanding is a more effective system of crisis prevention, which is still an outstanding issue. And with all due respect, I would have to say, in my view, that the swaps that the Fed provided to 4 emerging market economies in the crisis in 2008-9, I thought were not helpful systemically. To the contrary, were destructive systemically, because it placed the Federal Reserve's Board of Governors in a position of making decisions that were important systemically, for which they had no background or clear mandate. And I thought it was a mistake to have avoided, as was the case, consciously avoided using the IMF or another multilateral institution, but specifically the IMF, to provide if there is a justification for short-term crisis prevention instruments, which I think there is, and still lacking, I think the IMF is the place for that to be done.
Thank you very much. We did not expect from the previous Vice Managing Director such a remark. Thank you very much. Daniel, you have the floor.
You know, when the deputy governor, the Central Bank of Lebanon, mentioned 50% rise in the population. I mean, this is mind-boggling. I mean, it's in Europe. In Europe, we have such a reaction, clearly, to a massive inflow of people for various reasons, and I don't want to get into details, but when you read or you listen to such numbers, I mean, an economy, a society can easily be ravaged. I mean, I'm asking myself, where do you find the resources? Because you have to help those people and provide, I mean, it's the critical mass of services, public services, to all of them, not only to kids. I mean, it's amazing. This is something we should ponder on much more, because we live in a world of conventional, of a myriad of proliferating conventional and unconventional threats with major adversary shocks, and I'm asking myself, how can we keep our societies robust, resilient when facing such shocks? I mean, we in Europe, probably we should learn from you. I mean, 50%, it's amazing. And I'm asking them, even if most of them do not decide to stay, but what if they decide to stay?
No, but I mean, the working assumption is that they will not stay. They will go back to Syria when the time comes, no?
Let's say, but I'll come now about the other issues, but so, on another scale, it's Turkey. No, welcome to reality. But the numbers are. Now, when it comes to banking regulation, probably I'm a prisoner of my, what shall I say, of my personal proclivities, but also of being a central banker now. Also, I was a member of the European Parliament, and I fought for enforcing a new regulatory and supervision system with Ike van den Borg. I was behind all the endeavor, and I believe we're not yet there, for various reasons. And I'm asking myself, if we do not succeed and we revisit a new big recession, and nota bene, this morning, Norbert Röttgen, who knows what he's speaking, he said very clearly that we're going to have a new recession, a new crisis. It's only a matter of when.
I have to say I was in full disagreement with this remark,
No,
personally.
Okay.
If the reference was something which would look like what we had in 10 and 11, I think we are in a totally different universe. But of course, a recession, certainly, and new challenges, certainly. But I would say, if I may, Daniel, this idea that we are still with an existential problem in Europe, with both the euro being in great danger when time comes and the euro area being in great danger, seems to me not to be really accepted. I mean, again, we had the stress test. It was the worst crisis since World War II. Could have been the worst crisis since World War I. The 15 countries were in the euro area at the moment of Lehman Brothers. The 15 are still there. And the situation of those who were vulnerable, of course, has been considerably improved in terms of current account or budget and so forth. And on top of that, 4 new countries got in the euro area since Lehman Brothers collapsed. The 3 Baltics and Slovakia. So we are 19 today when we were 15. So I fully accept that a lot of market participants, observers, were thinking that we should explode, that we had to explode, that we were too bold, and that in this dramatic shock of the worst financial crisis, we should have been blown up, but we were not, for many, many reasons, and I take it as a stress test. So I'm not naive. We have a lot of very, very tough challenges. We have to deliver growth and jobs, and we have to face up with the populist nationalistic move, which we see in the US, in the UK, and in Europe, of course. But I would say the existential issue is of a different nature and doesn't seem to me the pertinent question personally. But I thought it was the right place to put my message. But again, I certainly agree with you that the challenges are gigantic.
Right. I mean, it's just to say, someone mentioned today also during our discussion the bailing-in procedures. Now imagine if Italy had been forced to implement the bailing-in procedures. So we are still, I think we are, to a large extent, we are still in the dark. And I believe that the ECB, and with all due respect to you, and because the ECB has saved the euro area. This is the reality. It's the ECB. It's not, it's the institutions, and of course, the ECB is an institution, but I'm talking about the rules and the policy arrangement of the euro area. And the ECB was the land of last resort, de facto, which saved the euro area. So this is the reality. I'm asking myself whether, again, the case of Italy is emblematic for what could go really bad. Now, but when it comes to bank regulation, I believe that we have to continue. I respect your position, Mr. Lévy, because I believe that if banks do not lend for the very reason you mentioned, 80% of our economic activity is bank-based. It's not like the United States. We do have a problem. On the other hand, we have the debt overhang. Europe is much more indebted publicly and privately. And this is the irony. In the world economy, if you look at how much public and private debt is in Asia, for example, even in Latin America, it's the reverse. It's a puzzle. It's a puzzle if you don't know. So, and then is the policy stance in the euro area. The current account deficit of the euro area is 3% of GDP. Germany is running a current account surplus of 9%. It's the policy stance which is not right. You cannot ask governments to implement austerity policies at the same time with running such a large current account deficit. And then I'll get back to your question. Imagine that the Fed raises the policy rate. We don't know, it's the pacing of rises in the policy rate, but in combination with a more fiscally expansionary policy because of big infrastructure works, that would absorb liquidity from global financial markets. Most badly hit are going to be the emerging markets, which are heavily exposed to the US dollar. But fortunately, not many of them are in much better shape macroeconomically than in previous decades. So there is still a lot to do in Europe when it comes to completing the regulation and supervision. One has to, the devil is in detail, it's true. One has to look at the specifics of banking sectors. Now, when it comes to productivity and secular stagnation and world dynamics, this is a huge topic. This is a huge topic, and I'm glad that John mentioned Paul Davies, and we have waves. And I remember Kondratiev with the Kondratiev theory, the long waves theory, which I believe is pretty illuminating, because that hooks up with Schumpeter's view of how we have clusters of key technologies which shape the dynamics of the global economy, of national economies. And maybe now we are now on the downswing because of the financial crisis and because of the old technologies. But the new upswing is not yet in sight. And in addition, we're going to have massive labor dislocation. And to believe that we can turn rapidly people in their 40s and 50s, in their 30s, from doing a range of jobs into doing another range of jobs, this is ridiculous. So we're going to have I think a cohabitation of slack and labor shortage is, as Monsieur Lang has mentioned. I mean, it's, we shed labor, but at the same time, we have a shortage of people in other sectors. It's like in the old command system. In the command system, the communist economies, we had both shortage of labor and slack of labor at the same time. So, and I believe that this is now currently in market economy because of the pace of change. The pace of change is so swift that it's very hard to have people moving rapidly and changing. There is a hell of a difference between producing pizzas and selling something in the store, while previously being an engineer and moving someone into a lab. There is no way to move someone to a lab as a researcher. I mean, but this is a challenge for most societies. Now, there is a topic which we have not touched upon here, and it's linked with protectionism and limits of globalization. Personally, I think that Danny Roderick, and this is a view I have been espousing for years now, that we may have gone too far with globalization. It's fine to have free society, democratic societies, to have free borders when it comes to goods and services and so on, to have even movement of labor, because this is what defines, I mean, it's open societies. But if we're not careful enough, and we do not understand under how much strain a society can be because of the intensity of movement, of labor, of capital, then we might erode so much what we define as social cohesion and the underpinnings of a democratic society, which is the middle class, then everything will erupt. And what's happening, I think, what's been happening even before the eruption of the financial crisis, with erosion of the middle class, is showing up in social and political strain.
Daniel, with
okay, and that's I finished.
Some absence of prudence, I had told you that you will have a lot of time. Still, we are only 10 minutes from the end of our session, if we want to be. So, thank you so much. When hearing you, I was struck by the fact that you mentioned pace of change. It is the rapidity of the changes in globalization, in the openness of in the restructuring of our economies, in IT and science and technology, which our own people are telling us goes too fast. Could you slow down? And I interpret Brexit, I interpret Trump, I interpret the nationalist populist move in Europe, in the euro area, in all Europe, as more or less the message. Could you slow down a little bit all what is happening, because it's very fast. But I stop there, and we have several two hands. No, not two hands. You have to be extraordinarily concise, but you are the number one, because it seems to me, no, yeah, this gentleman there, and then you. Yeah, please. Please.
Thank you. That's not a question, but just to remind in the meantime, something not only, but especially regarding the euro. Right now, and after the Brexit referendum, the European political union is not at next corner, but far, very far. But the euro is here. In this respect, I should like to remind that since the Roman times has never existed a unique currency without political union. Thank you.
In the time of the gold standard, it was de facto a single currency with not the political union, but we are supposed to have a solid governance of the euro area, a very solid governance of the euro area, which comprehends SGP MIP, and of course banking union, not to speak of the political aspect of it with the European Parliament and the rest. But I agree with you. A solid governance at the center is, of course, compulsory. Thank you very much indeed. Please.
Just a sentence. But without, for example, fiscal harmonization.
Taxation harmonization, you mean? I mean, do you also call for commanding from the center the national public spendings of each country? No. Then you don't call for full harmonization of taxation. We have to be, I mean, it's complex, but we cannot redraw the document right now, but I take your point. Solid governance at the center. Please, you have the floor.
Yes, also a comment on the euro situation. First, without a doubt, there are very important problems. Everybody recognizes that. Big imbalances within the Eurozone. Big challenges, I would say, especially the one that worries me the most is Italy, for many reasons. But I also agree that a repeat of the existential crisis of the last few years is very unlikely, essentially because of the mechanism that was very important in causing the existential crisis, which is the unwarranted and one-time convergence of interest rate in the wake of the creation of the euro, which was very, very important in explaining the again, the unwarranted housing and other booms in Southern Europe. That was a one-time effect of the creation of the euro. It was wrong. The markets got it wrong. But this is not going to be repeated in the future. So the point is that insofar as we're able to deal with the existing situation and the current imbalances, etc., we at least will not face that kind of shock in the foreseeable future again.
Thank you very much indeed. I didn't see any new call. Yes, please. And then Governor Sharafeddin, please.
I forgot to say that there is an excellent paper by OECD on technology and productivity saying that the key point is not IT investment. When you invest $1 in IT, you have to invest $9 in non-IT, like reorganization of work and many other aspects to have real impact. So I think we should keep this in mind.
Thank you very much. Governor Sharafeddin.
Actually, it was a comment that you have mentioned that I would like to reiterate in response to what Daniel was talking about. What we're witnessing with the election of President Trump, before that the Brexit, with the de-risking, and with 7 out of the G20 countries have those populist movements. So we're witnessing the de-globalization, and I think sky is the limit. So this was the comment that I wanted to make.
Yeah, well, at least we are witnessing probably the, I would say, a freeze of, I would say, opening up of all markets. That's absolutely clear, and we see that with the treaty. Whether it will really transmit in diminishing of globalization, I have a difficulty to see how it could operate. That seems to me very complex. But the message that our people are sending us, slow down everything. They even are telling us, if I reinterpret what we are told in major countries, why do you augment contribution for pensions and or diminishing pensions? We did not ask for that. Still, it comes from the lengthening of the life expectancy, which is good. Nobody can challenge that. But my own experience in 2 institutions, it is the domain where you have the most opposition. So in that domain also, they are more or less saying, well, we were relatively content and satisfied with the previous state of the situation, and why do you want to change? And I have to confess, it's true that things are changing extraordinarily rapidly, and not surprisingly that our people are not fully satisfied. Of course, part of the difficulty comes from the fantastic success of the emerging economies, and it is exactly what we had asked after World War II. So we are in a situation where we have to manage formidable successes. Science, technology, the rise of China and India and Mexico and so forth. But I see, John, you have a point. You have two hands, please.
Very brief. We've discussed a lot about Italy, and I'm a little curious. One big change in the structure of the Eurozone since the crisis was the creation of the ESM, which has the power of directly recapitalizing banks and bypassing the sovereign. I'm puzzled as to why this option isn't discussed in the Italian case, since it seems almost made for that.
Have we got Italian citizen around the table? No? Well, I dare say what I understand is, of course, as Spain knows, when you have such an intervention, you have conditionality associated with it. And when the time was coming, the Italian government didn't want to have the conditionality that was associated with that. It was probably a mistake. Now, your question is also, why is it so difficult to get out of the situation in Germany as well as in Italy? And there we are back to bail-in. Bail-in was mentioned by practically all speakers. And I have to say that, seen from my personal standpoint, bail-in is fantastic if you do not have systemic problems. And that was the working assumption. The working assumption was that we clean up the situation, we do not have any more systemic problem, then, of course, not only Lehman Brothers can collapse, but Citi can collapse, and we have no systemic impact. The fact is that we are not yet in that situation, and it is true that the Europeans have introduced rules that are very, very strict, in line with the concept of the single market and no unfair competition and so forth. But the result is that it complicates, in some respect, what has to be done with national, I would say, capital and national public capital. Clearly, at least in the case of Italy, it's absolutely clear. So, but that can be negotiated with the Commission. So I don't think that Italy doesn't do anything because they have no money or no capital. They could certainly intervene. They are prevented from that because it's the rule. The rule is that you should not do that. And you should ask the creditors of the bank to take a hit, as has been theoretically considered as optimal. But of course, it's a little bit more complicated. But I remain absolutely convinced that a negotiation with the Commission would permit to do what is obviously necessary. Now, even if we are in the best of the world possible, my understanding, speaking under the control of André in particular, is that it is clear because the US paradoxically are more socialist than the European countries are, namely Freddie Mac and Fannie Mae, are introducing an element which is semi-public and which protects the banks from a lot of risks, and they can concentrate on what is profitable and their profitability. One always says they were much more rapid in recapitalizing and so forth. No, I take it that they are in a better structural situation. But of course, it doesn't mean that the system was not very fragile. The difference between us and the US is that we try to give liquidity to the banks on an unlimited basis since the very beginning, and the US Fed gave, since the very beginning, a formidable help to markets in providing liquidity to markets in a way which was unseen, of course. Please.
Yeah, parenthetically, one of the, as you know, Fannie Mae and Freddie Mac were intervened and have been under a conservatorship, basically managed by the government, owned and managed by the government, as a previous odd situation of publicly chartered and privately owned. It is apparently possible that the new administration will be interested in resolving that situation that was intended to be temporary. In other words, it's possible that there will be an ultimate privatization of those institutions, whereas previously they were considered untouchable. Be very interesting to see if this happens.
Thank you very, very much indeed, John. Yeah, two hands, please.
Yes, well, very briefly. I think that in Europe, if I may say so, we've been a bit slow in cleaning some of the balance sheets in some countries. So that's a fact. And in the US, they have been much reactive since the very beginning of the crisis. And I would add that one of the tools which is quite instrumental is the securitization. I mean, securitization in Europe, unfortunately, doesn't work. It doesn't resume, while in the US, after the crisis, well, they've been using this tool as a way to clean the balance sheet and unload some of the assets. So that's one of the elements I would put on the table. Thank you.
Yeah, thank you. And you have, if we would concentrate on Europe, then you would see that the concentration in some countries is very high, in other countries is extremely poor, which is very abnormal. You would see that there are disincentives to cross-border restructuring, which is a paradox because we have a single market. It's supposed to be a single market of the financial services, and still, when you purchase a company in another country within the euro area, you have a hit in terms of regulation, which is aberrant. So we have a lot of things. I mean, it's, no, don't forget, Europe is history in progress, work in progress. we are not a steady state at all. I mean, we are exploring things permanently. I want to be absolutely sure that there is no remarks, observations, or question which remains in the table without being expressed, because I think that, again, the interest of such a panel is that we discuss as much as possible. That being said, I'm not unhappy because it's 12:35 and we were supposed to close at 12:30. So if really there is no more things to be said, thank you very, very much indeed.